So before we jump right into the case studies, we want to just touch on a couple of the evaluation techniques that you saw in the modules this week. Get those back, make sure they're fresh in your mind before you start the case study work. Eamon, would you like to lead us through the beginning few slides here?
Yeah, sure. Okay. Hi, everybody. Hope you're okay. Hope you're having a good day. And so, so today, this morning or this afternoon, this session is about GI evaluation reports, and we'll have a case study. We'll work through the case study and GI evaluation reports. And as Jeff was saying, we'll do a quick recap on some concepts, and then hopefully, once we get into the case study, hopefully that'll generate some good discussions. And it'll be very interesting to hear people's thoughts about what they think about that evaluation report. So we firstly want to do a quiz. Sorry, is this on the poll or is this through the slides? I forget.
This will be something Rochelle will launch the poll.
Okay, Rochelle, if you want to launch this poll, please.
Yes, it's loading now. Is the text also supposed to appear in the slide, Jeff?
No, we can. That was just there for the creation of the poll, but we don't need to talk through it on the slide.
Yeah. So the first question, excuse me, is which of those three items there are reserves for known claims? So we'd like you to click on any or all of those which apply. So IBNER, IBNR cases, which of those, maybe one, and maybe two, maybe three, are reserves for known claims? Okay, very interesting. Okay, so we have 38% say IBNER, 28% IBNR, and 34% is case estimates. Okay. Well, the correct answer actually is IBNER and case estimates. So what we're talking about here is known claims. So if you know about a claim, then you will have a case estimate on that. So that's the straightforward one. You usually will have a case estimate on that. So that's straightforward. But then when we think about what is IBNER, IBNER is meant to be incurred but not enough reported. So it's basically where you have a case estimate, but usually case estimates are never, usually they're not enough to cover the claims because of development, because they're put on a very early stage. So IBNER is meant to cover development of those case estimates. So for example, if you have a case estimate of 100, but really ends up costing 120, so the IBNER is that extra bit, that 20. And then IBNR itself, incurred but not reported, is where you don't know about the claims yet at all. They've happened, but you haven't been notified. The insurer has not yet been notified, so you don't know about them. So the one that's missing from those three is IBNR. So IBNR does not apply to known claims because you don't know about them yet. So you can't have that. So for known claims, you will have a case estimate. You will want to see an IBNER on top of that to allow for development of case estimates. But for the known claims, IBNR does not apply to them because IBNR applies is basically where you don't yet know about the actual claim. And we'll go to an example actually later on in this morning too, so that will hopefully flesh out some of these concepts. Can we do the next poll, please? So this one is, so gross reserves minus recoveries equals what? So of those three items there, if we have gross reserves and we take off recoveries, what is what's the answer to that? It's one of those three. Okay, so 88% said net reserves, so that is the correct answer. And 13% said central estimate. Okay, so for those who picked central estimate is actually basically the terminology to describe what an actuary has as their estimate for reserves, and it's meant to be sort of neither too high or too low. It's meant to be sort of in the midpoint of the ranges of possible estimates. You can have a gross central estimate and you can have a net central estimate. The central estimate is just, there could be a range, it could range between 50 and 170, and the central estimate might be, for example, 110. That situation. So a central estimate is meant to be sort of the midpoint of the range, but that number could be a gross or it could be net. So you can have a gross central estimate or you can have a net central estimate. Okay, so moving along, we will go to a worked example. Oh,
I think someone accidentally took over control of the slides, so I'm just going to upload them again, which takes a second. It's not a problem, so just maybe as a quick reminder, if that happens, that you accidentally take control of the slides, please don't end the presentation, but just let the trainer take back control, and then it's a bit smoother, but not a problem.
Okay, so I want to go to an example. We've got two examples of valuation techniques we want to show, and it helps to illustrate some of the concepts. The most simple of all is what we call the loss ratio approach. So where the actuary, for whatever reason, is using a very, very simple approach. It may be because this is a very immaterial class, very limited information. It may not be for year-end reporting. It may be for sort of intermediate reporting. So they may have a particular logic to using this type of approach. So in this example here, we have a net earned premium of 100, and we've paid 45 so far in claims. So in order to apply this approach, we need to assume a loss ratio. So if we assume the ultimate loss ratio on that $100 is 60%, so that means that the incurred cost, ultimate incurred cost, will be 60% times 100, so it'll be $60. So premium of 100, we assume an ultimate loss ratio of 60%. So that implies that the ultimate cost, the total cost of all claims attached to that policy, for example, would be 60. And we paid 45. So our outstanding is 15. So we expect the total to be 60, paid 45, the difference is 15. So the outstanding claims number will be 15. I'll just offer a minute to see if there are any questions. If anybody has a question on that, before I move on to the next example, I'll give people a minute or two just if there's something on that you want to raise. We can address quickly in the chat. If you have a question on that, please raise it now in the chat. Okay. I assume there's no questions on that. The next one we want to go through is a little bit more. Oh, here we have one. Sorry. Okay. They're not able to then. So in the next example is a little bit more sophisticated, still fairly rudimentary, but it will hopefully illustrate some of the key concepts. So this is what we call the number and average cost method in general insurance. So we're trying to estimate what will be the numbers of claims, ultimate numbers of claims, and the cost attached to those. So we've had 80 claims reported so far on all the policies in this class of business, but we've paid $10,000 on 50 claims. And we have case estimates of 4,500 on the open claims. We also think that on average, about 80% of the claims are usually reported by this point in time. But we're not sure about claims inflation, but we think it might be high. Question is, what should we, if that's all the information that you have, how would you estimate an outstanding claims liability? Let's say that's all the information you had. Very basic amount of information, but this is enough at least to a first goal, something, if you had to do something really quickly. So 80 claims reported. Of those 80, we paid 10,000 on 50 claims. So that leaves 30 where we have not yet paid. And these are still open claims. And we have case estimates of 4,500 on those 30 open claims. But the fourth bullet point is quite important. We think that on average, 80% of the claims are usually reported by this point in time. This is quite an important thing. This goes back to the IBNR question, where the claims have incurred but have not yet been reported. So if you have 80 claims reported to date, and we think that on average 80% of them are usually reported at this point in time, these are nice round numbers. So then think, what would be the total number of claims that will get reported? And claims inflation. So we have a worked example where we walk through the numbers here. So we've broken it down into different components. So we've broken it down into where the claim has been reported and has been paid, where it has been reported and has not yet been paid, and then IBNR, claims that have not yet been reported, that have incurred but not yet been reported in the totals. So as I said earlier, 50 claims reported and paid of 10,000. So the average on that is $200. There's no claims liability for that because we paid on those claims. So 50 claims we paid. They're done, they're settled, there's nothing to worry about those. So where we have a liability is on these two second parts here, part 2 and part 3. Reported and not yet paid, and true IBNR incurred but not even reported yet. So for this part here, reported and not yet paid, what we could do is just assume that the case estimate is sufficient. But the question then is it really sufficient? Because if you think about it, the average cost in these claims is 200. We've got 30 claims here. So if the average cost is again 200 or even higher, we would need 200 times 30, we would need 6,000. But the case estimate is only 4,500. And because claims inflation is high, what we're assuming, let's say we say the average cost will be a bit higher because these claims haven't yet been settled. They might take a time to settle. Maybe there's quite high inflation there. So we say 220 is the average cost for those. So the total cost on those 30 claims will be 6,600. It will be the 220 multiplied by the 30. So we have this case of 4,500, but we think actually for these 30 claims, it might end up costing us around 6,600. And so this gets into the question of IBNER, incurred but not enough reported. So we need an additional 2,100 on top of the 4,500 to get to 6,600. So and the total claims liability is equal to the case estimate plus the IBNER. So that's quite important if you think about when you see, if you see a evaluation report where the actuary is just setting the liability equal to the case estimate with no allowance for any development of IBNER on that. They're assuming the case estimates are perfect, that there's no shortcomings in those at all. That would raise a question in my mind. Then in terms of the IBNR, the incurred but not even reported yet. So as we said earlier, 80 claims reported, and usually 80% of them are known at this point in time. So that would apply to get to 100%. We need another 20 claims. So we will expect 20 more claims to come through. Then the question is, what would be the average cost on those? And because they will be settled after the ones that are reported and not paid, after the 30 claims. So it'll be settled even later because they have to come in and they have to be reported in our systems and so on. So there'll be more time for inflation. There might be the cost might go up even further because it's a little bit further away in time. So we might assume a higher average cost on those claims. Let's say 250. So 20 claims, 250, total incurred of 5,000. This is pure IBNR, 5,000. So the liability for that part is 5,000. So total liability is 11,600. So we're going to move to the to the case study shortly, but I'll just stop to see if there's any questions or comments in the chat because I think it'll be worth sort of exploring this for a few minutes. We're a little bit over time, but I just wanted a couple of minutes, give people a few minutes to kind of raise any questions on this. And Jeff, if you want to jump in, please feel free.
Sure. So I see one question in the chat from Tesfa. How do you consider outstanding claims brought forward from preceding years to compute incurred claims? So you're asking about claims that are known, they've been reported, but they've still been they're still pending payment. Maybe they're being pondered by your claims manager. So yeah, you need to hold that in this example would be among the 30 claims you see in the second column. And so you need to hold a reserve for them. It doesn't matter in my mind whether it was incurred in a prior year or the current year. It may be useful for you when you track your, for example, your loss ratio by year to know whether that's a prior year or a current year. But as far as holding a reserve for it, you have to hold a reserve for it just like as if it was incurred this year. Eamon, did you have something else on that question?
No, that's true. That's true. Yeah, I agree. I'd love to see a couple more questions from people. Any questions? Good questions. Okay, I'll give people 1 or 2 more minutes, but I'll just stick for one or two more points before we move on to the case study. So what's challenging here, and sort of what is kind of a key assumption in here, and we talked a little bit about this yesterday, and we'll get into that in the case study. Is what are the key assumptions if the actuary is using this approach? You have to think, okay, so what are the key assumptions in this work? And one of the first ones is the percentage developed. So to estimate the IBNR in terms of the numbers of claims that are not yet being reported, we said 80%. Maybe it's wrong, maybe it's 70%, maybe it's 90%, maybe it's 65%, maybe that percentage varies over time. So it can be quite uncertain. Sometimes it can be quite stable depending on the class of business, process, lots of different things. So that's an assumption. And in that case, you'd hopefully want to see some supporting work to support us, some justification around that, and maybe potentially a sensitivity around that.
Podem não vir até agora tá tudo bem.
I wasn't sure if somebody wanted to ask a question there. And then the second one was about the average cost on the reported and not yet paid and on the IBNR. So in this example here, we give you a hint that there's significant inflation. So that which is quite material. If they settle, the average cost today is 200, and we think it's going to be 220 on these and maybe 250 on these ones. But that's an important assumption. How much will be the cost? What will be the average cost in those claims? And it depends on the class of business. Sometimes classes of business, liability class, can take years to settle. Years to be notified, and then it's quite a long time to settle. And there can be very significant inflation there. For health insurance, you can have medical inflation. So there can be factors that can push up the average cost. It's usually going upwards, or there could be issues with exchange rates could bring volatility in the average cost. So So yeah, these are so that's the second key assumption, is the average cost. Okay, I was hoping for a few more questions, but if there are no questions, maybe we can go to the case study.
Yeah, so there you go. We have 4 trainers today, and we're going to split into 4 breakout groups. So you've met all of us, Eamon, Britta, and Janice. Janice, is this your first? No, you've met Janice on some other sessions. I don't know if she's had to lead anything yet, but
Yes.
okay, sorry. We're going to look at the general insurance case study. You should have all had time to read it now in the modules, and hopefully you have a printed copy. And each group is going to work on a different question for 30 minutes, and then we're going to come back, and or maybe 25 minutes. We're a few minutes behind. Rochelle, if you could give us 25 minutes in the breakout rooms. Then we'll come back and share our responses. So we're going to need someone in each room to volunteer to be the note taker, to share their screen, to pull up the template and share their screen and take notes. And then we'll need someone when we come back, either the same person or a different person, to talk through those notes when we share it with the group. So some of the questions you will be answering in your groups is regarding the outstanding claims liability from the information provided in the case study, which is a valuation report. What are the main drivers of change in the outstanding claims? That will be those of you who find yourself in a room with Eamon. Second, are there any areas of concern in the claims liability? That will be for the folks who find themselves in a room with me. Next, do you have enough information to fully understand the process adopted by the actuary in estimating the technical provisions? Are there any other items you would request? And that would be those of you in a room with Britta. And the fourth group will be this question 2A. What are the key risks for the insurer and why? So what do you see in the case study that concerns you about their solvency? What is the capital needs to support these risks? Those will be those of you in a room with Janice. And then this last question, 2B, we'll save for when we're just all back together. Do we have enough information to understand the risk management of this insurer? Any questions or comments from the participants or trainers before we launch into the different breakout groups? Did everybody finish?
So,
Thanks, Mike.
Teams has changed something, so I can no longer move people between rooms, so I need to recreate them again. It's just that option is gone now. Maybe in the meantime, the template.
I will post the
Links to
templates and
be
you can take care of the rooms. Maybe that help.
They just Teams options just changed overnight, so my apologies.
One other thing we could discuss while we're working through this is some of the forum questions that have come in related to the technical actuarial valuation techniques. So I've been trying to respond to some of these in the forum, but I'm not sure if everybody's seen them. One that was brought up that I remember is, how do you come up with the margin for adverse deviation, or the margin over the central estimate? And I think that in some cases, different benchmarks are used. So, I mean, maybe it's common to use 10 to 15%, unless it's a really unpredictable and volatile product, then maybe you go 20% or higher. And if it's a really, really predictable, maybe you can go less than 10%, say 5%. There are statistical techniques that are certainly beyond the scope of this training, but you can look at data and try to say, well, we want to be 75% sure that we have enough margin that we're going to be, sufficient, and that requires some modeling, stochastic modeling, and so forth. But maybe for the other trainers online, am I in the right ballpark? You think 10 to 15%? And I mean, really, you'd want to look at the insurers in your area and see what they're using to see if that is about the right benchmark. But Eamon or Britta or Janice, what do you think about the approaches for determining the margin?
Yeah, I think that in relatively unsophisticated regimes, that you find that it's just going to be a percentage because of the complexity of the modeling. And I know that in Jamaica, the actuaries don't get too into the details of actuarial valuations. So it's more of a compliance report than a true valuation report. And so, yeah, the detailed methods are not used. So just a percentage applied.
Yeah.
Okay,
Yeah.
the rooms
One
are
option.
ready. We can continue the discussion, but just to interject that the rooms are ready whenever you're ready.
Okay, one thing I would say to that is, yeah, it's really thinking about how uncertain you are about some classes. So, like, some classes are fairly predictable in the short tail, like motor generally. If it's not bodily injury, if it's just property damage, it's fairly more predictable. What will be the cost? We should hopefully be more certain what the claims loss will be, claims estimate. Whereas more longer tail classes, which are more volatile, you would have a higher margin. One other thing you could do is, or you'd like to see is in the report, is how much out they were on the reserves last time. So if you have the same actuary doing the reserves year on year, you'd hopefully like to see that last year we estimated it would be 120, and it's actually deviated by plus X percent, 5%, 10%. And you look at that going over time and see how far out they were in the reserves, how wrong they were. They'll always be wrong, it's just an estimate. And that's a good benchmark also. It's an internal thing. And there may be limitations to that, you may not have the same actuary over time, same methods and so, but that's worth looking at, So if you're picking 10% as their margin, but in the last 2 or 3 years, they were up by 20% each time, they went up by 20% each time, then you'd wonder. So.
Okay, thank you. And I appreciate the people who post questions on the forum. I'll keep checking to see if there's more that I haven't answered yet. So I think we're ready for the breakout rooms. Let's try this again. Everybody back? Everybody wish they had more time?
Yeah, it felt like the time just disappeared.
Yeah, it's always the way the case studies go, but that makes it like real life, right? You never have enough time.
Very true.
I was mid sentence and just bang. Okay, we're starting to make progress. Yeah, it's not enough time.
Do you want someone from Eamon's group want to lead us first?
Clinton, do you want to? You're the scribe. Do you mind at least talking through the points on liability that we got into? Thanks.
Okay, so we were able to look at some of the drivers of the change in outstanding claims for the liability line of business. We established that the payment for earlier accident years were higher than expected for the liability line of business, and this was evident in the progression through the years. In the earlier years, they were paying more than they actually expected. So they did 117%, 119, 118, but somewhere along the line, it fell in place. And taking into consideration the past 5 years, they had paid exactly what they expected. So that was the first point. The other is because of they saw increase in case estimate for some claims yet to be settled. So when you look at the commentary that they actually made about the liability class, he said for the liability class, payments for the earlier accident years were higher than expected. And then they also saw increases in case estimate for some claims yet to be settled. So we stand to reason that if the case estimates are going high for outstanding claims, then that was also going to cause a change in the total outstanding claims for the liability class. And realize that these two factors mentioned earlier were the ultimate causes of the more recent accident years. Yes. And then we also look at the loss ratio for the liability class.
Yeah, keep going. Perfect.
Yes, so we realized that they progressed steadily over the years. So it was 58, 59, 59, 63, and then 69%. So the loss ratio also went up, and that was also another driver for the change in the outstanding claims. We were talking about the motto before we were supposed to join the main room again.
Right, and I probably should have mentioned before Eamon's group started presenting that their question was, what's driving the change in experience? Comments and questions? Or Eamon, anything else what were you guys discussing when you ran out of time?
Okay, so when we went out of time, we were discussing the motto class of business. We realized that the methodology there was a little bit relaxed when you look at the actual versus expected over the years, but we were yet to delve deeper and assess it. So we realized for the property, we're doing a little bit over what we expected to pay. So the actual versus expected was 112%. Yeah.
Anyone have any comments and they want to add to chat before we go on to group 2? Or Eamon, anything you want to elaborate on?
Yeah, actually, Clinton, do you mind showing the Word document again, please? Yeah. So you're bang on it. So just if you see here, yes, so the point here was on motor, the total payments were 22.4 versus expected 20, so actual versus expected 112%, and particularly high for 2018. This is a short hair class, so most of the payments will be for the most recent accident year. But if you go down, please go, you can go down to the commentary section. Yeah, the commentary after the results, yeah. Right, yeah, so you see that paragraph there where it talks about motor, property motor, excuse me. The claims are close to expected for the earlier accident years, but higher than expected for the most recent year. That's 119, 117%. But then the actuary says, however, this is not a concern, as the premiums written in 2018 were higher than expected, increasing both premium income and claims costs. So on the surface, that seems that, okay, your payments are higher than expected, but your premium is higher. But if you go a little bit lower down, if you look at the loss ratios, look at the loss ratio for 2018. No, it was just below the commentary. Yeah, here. Yeah. So, yeah, that's it. So they were saying that payments were higher than expected for 2018. And then they said, well, that's not a cause for concern, as the premiums were higher than expected. The premium income and claims costs were higher. But then we see that the loss ratio is actually higher. So even though the premiums were higher, they're not sufficient. The profitability is deteriorating, but the loss ratio is going up. So it's not adequately covering the increase in claims costs. So that to me is a bit of a disconnect. So that's something I would sort of query as to, you're saying that, okay, premium is higher than expected and claims are higher, but your loss ratio is deteriorating, it's going up. So that's a bit of a question, a bit of a concern of focus area. I think that's where we were. So can stop there.
Okay, well, I'm not seeing anything in chat, but as we go through this, people just go ahead and type in chat as you have ideas. if there's nothing else, we can go on to group 2, which Mark, if you could share.
A while. Yeah. So for group 2, we really ran out of time and we were not able to focus on the question assigned to us. We studied the case per section. So for data, we want to know we want to determine whether reasonable test is done for the database supplied, and for the liabilities report, we want to have more investigation on the deterioration of the actual over expected, the development of claims. For the claims methodology and assumptions, we noted that the assumptions used were not changed despite the observed change in the development or incurrence of claims. And for the liability class, we noted that a different methodology is used, so we want to be justified for that. And for claims with longer duration, no discounting is mentioned in the case. For liabilities report regarding the results, what caused the change in experience, and we have other observations such as the basis for the 8% MOCHI and the cause of the increasing loss ratio.
Right. So yeah, our question was, what are areas of concern in the liability? I think there's one really good table in this, so I'm not sure everyone who's read this case study, I want to make sure you interpret this because it's a really useful table. I just think that the person who wrote the report, you would say, well, what are you doing about what you're seeing? So if we want to scroll down to that fourth page. Okay, one more, I guess. This guy. This is a super powerful table with lots of great information, and I just want to make sure everyone knows what you can derive from this. So just looking at the first row of 2014, the first column, you see that our reserve right now is 3.1. Go 2 more columns to the right, and you see that the claims paid during the last year are 2.1. You add those together, and that is 5.2 million. And so we would like to say, well, a year ago, our reserve should have been around 5.2. So we'd have enough money there to not only pay claims, but it would also be sufficient to fund the ending reserve at the end of the next year. But if you look at the number in between, the middle number, the 4.1, the reserve of the prior year was not 5.2, it was 4.1, which means it's about 1.1 million shortfall in that reserve estimate from the prior year, and that's what you see in the rightmost column. So over and over again, every row in this table shows you that it looks like the prior reserve estimate was low, and it's a great table, but you'd like the actuary who wrote the report to do some investigation as to what's going on, and should we be concerned? I don't see any activity in the chat. Are we okay to move on to the third group?
Okay, for our group, I don't know if we have a spokesperson because I was asking for volunteers and nobody offered. So, but Shanice, if you could share your screen, please. And another call for volunteers to speak from the group. All right, Shanice, are you willing to speak? It's unfortunate if you volunteered to be scribe, but also have to speak.
No problem at all,
I
President.
can speak to...
Oh, thank you. I see we have a volunteer. Thank you,
Okay.
team member.
Great.
Okay, I can speak to the issues that we're discussing in the group. The first aspect that we picked is that the information was not split by business lines. So as a person analyzing the report, you would not understand where the figures are coming from and which products or business lines are having enough impact. In terms of the development factors, we require the actual loss ratios from the information and the assumption used in calculating the losses. It's not quite clear from the information that is provided in terms of what the actual loss ratios are and the assumptions that has been used to calculate the losses. Then they use the chain ladder method in terms of coming up with the IBNR, but we are not seeing the development factors that were used for this method. So these are required. We would want to see that information. In the report, it just states that the MUCHI is set at 8%. There is no justification or explanation or basis upon which this 8% has been derived. So we would want to know the idea, the reasoning, and the support behind the 8% so that we can check its validity and reasonability and also compare with the information that is provided. There is issues to do with the reinsurance. We are not given information on the recoveries which are linked to the reinsurance on the property line of business. We also require information to do with the premiums just to see how big they are, how they are developing, and how they are linked to all the information that is there. We require the information on the assets as well. It's not there. Then when it comes to the report, we require the actuary at least to express their opinion on the financial soundness, on the validity of assumptions, just to understand that after going through all the figures, what is the opinion of the actuary when coming up and the conclusions derived from the information that has been presented.
Yeah, and overall, the most important thing is that it seems as though the lines of business were all treated pretty much the same. And you want to see that the actuary is paying attention to what's happening in the lines of business, what's been happening year on year, and that they're taking that into account when they actually value the liabilities. And there's not enough information in the report to really see that that's going on. You want to see that the MOCHI does take into account how different, especially the motor and property lines of business are, because we would expect there to be much more predictability with the motor line of business than the property. So the flat 8% would need some serious justification.
Right. Actually, so Eamon, you wrote any info there that we could use to estimate a MOCHI or to validate the MOCHI. I started to read that question before I realized that you wrote it. Go ahead.
No,
go ahead, Eamon. Go ahead.
But it links to the preceding comment by Eric. So if we can just spend 2 minutes on this, if we go to can somebody show the report and the table you have before, Jeff, where you're talking about that table, and especially column E. I can't open that. Maybe I don't know if somebody can do that.
Yeah, if you could scroll down.
Yeah, perfect. This one. Yeah.
Yeah.
So his question: what do we do with the reserve deficit? I think it's a brilliant question. This is actually what we can do to do a sense check on the MOCHI. So if you look at the modeling experience changes in column E, that's basically the deficit. And as Jeff was saying earlier on, for 2014, they were short 1.1 million. And for 2015, they were short 1.6 million, and so on. So if you look at the total that we held last year at 31 December 2017, so we had 4.1 million for 2014. We had 7.9 million for 2015. If you were to add up all those four numbers, that gives you 58 million, 58.7 million. Just take my word for it. And then if you add up the numbers, the modeling experience changes in column E for the same accident years, for those 4 accident years, that's 10.9 million. So last year we held 58.7 million for those years, but they've now increased in total by 10.9 million. So it's 10.9 million divided by 58.7 equals 18%. So there's your mochi. There's a potential mochi. There's a potential deviation. So basically, they were out by 18% in the reserves. But then now they're saying we only need to have 8% of that mochi. And it's, as Britta said, you probably need a higher one for liability compared to motor and so on. So straight away, there's nuggets of information buried in this report that, you know, and they actually wasn't necessarily hiding it, or maybe could have been a bit better at sort of describing what's going on. But straight away, you have information there that's quite powerful. So you say to them, why are you holding 8% now, whereas actually last year you were out by 18%?
Yeah, and I think that's a good point to make too, that it's not that the actuary is necessarily hiding the information. And it's very easy when you're a supervisor to get this mindset that the company, the insurer, or the actuary is hiding information. And sometimes that can blind you to what you really should be looking for in a report. Don't assume that something's being hidden from you, but look at what is missing from the information that's presented.
All right, good questions, good analysis. I don't want to run Janice out of time, but Janice, we have one more question to look at here from group 4.
So Tilani, are you comfortable to give feedback?
I don't mind, but I was just thinking, because we didn't discuss who's gonna make the presentation. If anyone wants to volunteer, it's fine. But if no one from my team wants to volunteer, I can present.
Maybe you can share your screen now and we can see if anybody volunteers.
All right, I've shared the screen. I don't know if it's visible now, but yeah.
It's there, yes.
I think Tilani,
All right, so,
you can start.
Yeah. So we've identified number one, the underwriting risk as one of the major risks, because there's lower premium rates, and then there's also lower collection of premiums, which increases the loss ratio and puts the pressure on the ability to pay claims and expenses, and also to realize the profits. We also noted down the concentration risk from the fact that there are many properties and motor vehicles in an area very prone to hurricanes. And asset risk, there's only a small percentage in growth assets and about 85% in low yield assets. And then there's, in as much as this could be the good strategy for a short-term company, we're not really sure if perhaps the low yield assets, which are safe assets, we don't know if they're really safe because there's no information to assess the credit risk. And then liability risk, there's more claim volumes coupled with low premium collection volumes. And then there's also little or no knowledge about the risk profile of the new client. I don't know if this fits in under underwriting. And then on the capital needs to support these risks, that there's a capital need to absorb the risks, and because the required capital may also be underestimated because of low premiums. For example, if the capital charges are based on the amount of the business or premiums that the business writes, if they're low, then it sort of underestimates the required capital. There's also a capital need to boost liquidity, especially when the insurer is experiencing low volumes of premium collection and has also set the premium rates low. And then we also realize that there's little information about reinsurance, so we can't say much about it. Thank you.
Thanks, Tilani. So maybe just an extra comment that we didn't get to talk about is there's very little in the report, even on that page where Jeff was looking at the liabilities being lower than they should have been, to explain what's happening. what's causing the liabilities to have been lower, what's causing the loss ratios to increase, all of these things, we would need to know more about that.
Yeah, I don't have anything else to add. Anyone else have any questions on the fourth question or comments on the fourth question? Delaney, while you got your case study up, let's see, if you scroll down to the very bottom, is there still, we have one more question we didn't have a group to answer. I was going to see if we could just read it off your Word document at the bottom. There, thank you, perfect. Yes, perfect. Question 2B. Do we have enough information to understand the risk management of this insurer and the related risk-based capital needs of this insurer? And are there any items of extra information we would request and why? So I thought we could just kind of do this through chat. We have a few minutes left. Looking for some people to either unmute and speak up or type in chat some things that would be an answer to this question. So, okay, Clinton's got his hand up.
Yeah, this is just to clarify the calculations that Emon posted. I just want further explanation on how we came about the 58.7.
So, okay, go ahead, Eamon.
Okay, so if we go to the results table.
So, Delaney, if you go up to page 4 where we had the liability table.
So if you take that results table and look at the second column, which was the results in December 2017. So this report is for setting liabilities for December 2018. So this is a case study from 2 years ago, 50 years, something like that. So we use this work in 2019 training. So if we add those 4 numbers in that second column, that equals 58.7. So that was the total liability. So total was outstanding claims that was booked, or what the actuary had estimated at 31 December 2017. Yeah. But then what actually happened in the fourth column is there's model and experience changes. So they've actually they've had to increase their liability or their view on the cost for each of those accident years. So take the fourth column and add up model and experience changes for those same 4 accident years. Yeah. Which is 1.1 plus 1.6 equals 10.9. And that's basically a year ago they had 58.7. Now we're saying actually we needed an extra 10.9 million or whatever dollars. So the deviation or shortfall was 10.9 million on 58.7, which is equal to 18%.
Yeah, thank you very much, Emon.
Does that make sense, Clinton?
Yes, it does. It does.
Okay, cool.
That's impressive typing, Eamon. Fast typing and speaking at the same time. We had a chat comment from Mark related to this question of do we understand the risk management system of the company? Mark offered perhaps the risk management system documentation to understand the RMS of the company. Yes, that would be helpful. We don't really have a great big picture of the company, right? Like we don't see what their income statement looks like. What's their volume of premium? What's their volume of claims? What's the required capital sufficiency right now? Do we have any information on this? Do we know, should we be getting concerned because the required capital ratio is getting close to some, regulatory threshold? Yeah, I think that there's a lot of good pieces in this case study, but maybe the actuary could have gone a little bit deeper to give the regulator some comfort that there's not a solvency issue around the corner. I don't have anything else except to thank everyone for participating really well, and I'm looking forward to the next case study after our hour break, where we look at a life valuation report. Anyone else? We still have a couple minutes here. Anyone have any final comments they want to add to chat or anything from the trainers?
No, I think I'd just say that this is a good example that you can use to think about how you'd approach a real valuation report. So if you actually get one, it's often intimidating at first. You don't quite see the information getting through to you. But if you go through slowly and look at what they're actually telling you, and then think about what information you'd need to understand the figures that are being presented, slowly but surely things fall into place. Because even if you're just going from one actuary to another actuary, the reports are going to look different. So don't think you need to see the information at first glance. Just go through it, piece it together, and start to dig a little deeper, and it'll start to make more sense.
Clinton?
Yeah, so I wanted to know, in our jurisdiction, the practice is life insurers or life insurance companies are supposed to submit actuarial valuation reports and financial condition reports. But same cannot be said of the non-life insurers. They just submit the financial condition reports. Is there anything lacking in this?
So if I could restate that you said that for life companies, they have to do more extensive reporting than non-life?
Yes, so apparently I was just prompted by my colleagues that there is the new act that mandate them to submit an actuarial evaluation report now, beginning 2021, yeah.
Okay,
But that wasn't the practice earlier. They were not submitting any actuarial reports except the financial condition report for the non-life insurers.
That seems like a disconnect. Yeah, maybe. I don't know why one type of business would be different than another, and except that maybe the life products might be longer duration, and on apps, not all of them, but some of them would be on typically longer duration and have different types of risks.
That's actually close to what we had in Jamaica, where for a long time, the life insurance companies, they needed actuaries to do the work that they were doing, partly because it's longer tailed. And so you had in-house actuaries for the life insurance companies, but not for general insurers. And we did, this might have been about 15 years ago, that we started asking for actuarial valuation reports for the general insurance companies. And the problem with that was that we ended up with it just being compliance reporting. The reports were being submitted because the supervisor asked for them, but they weren't actually being used by the companies. And so I think that that's probably something you need to pay attention to, as to whether or not the actuaries are just being paid to submit a very expensive report, or the information is actually being used by the companies, because you want to see them using the information that the actuaries are providing.
So in South Africa, they used to have a sign-off thing in the report, the regulatory returns, where the board had to sign off to say that they'd read and understood the actuaries, or at least understood most of the actuaries' reports.
Yeah, I think it's just the history of how insurance has evolved in some, and the regulation of insurance has evolved in some markets. Traditionally, years ago, there was a prescribed role for an actuary in a life insurer. They had a statutory role, and often that was embedded in the Insurance Act, and that wasn't necessarily the case for non-life or GI. And that's becoming much more common now. But there's still jurisdictions where there isn't a prescribed role for the actuary in general insurance, because it's a short tail business, but there's still material uncertainty in numbers. And sometimes even the reserves could be set through legislation, through regulation, and the IBNR could be X% of premium. So in theory, there wasn't the need for an actuary there. So that is changing. Most markets, most jurisdictions require an actuary in a general insurer. But if you're seeing that there is a need for an actuary in a general insurer and an actuarial report, you might find that in the early days of that new regime, the quality of the reports and the quality of the data that the actuaries have access to may not necessarily be as good as it would be in a life insurer. So they could face real challenges getting the data that they want to do proper sound actuarial analysis, because there may not have been a history within the company of collecting that type of information. So that can take time, and that can take time so initially you can't expect a superb, brilliant report. You want something meaningful and informative, but it can take time. So it's always good to see that things evolve as well. You'd like to see some evolution within the insurers as well, that they're building up a good data history for the actuary to build sound models.
So we had a question from Adriana in the chat, and I tried to be like Eamon and type fast. So I'm gonna read her question. Going back to the shortfall of 18% that we saw, what would be possible reasonable explanations from the company? What would they do to improve the modeling and experience? My answer would be that the actuary in the data section of this report said they had some really good databases of data. They could easily go back and validate the assumptions. But instead, on page 3 of the report, the actuary said that they just keep using the same assumptions that were used in the past for reserving, the same chain ladder development. There's not being any effort to update the assumptions. And one solution is to increase the MOCHI from 8% to something higher, but probably a better solution would be for someone to go back and revise those assumptions based on current history, because then you wouldn't have these deficiencies developing. There might still need to be a higher MOCHI, but I mean, I would advise that some effort be done to update those chain ladder factors. Well, I think this is really successful. Hopefully everyone got a couple of things from this they can take home and apply in their work. We will see you back. Janina, is there anything that I'm forgetting, or are we ready to take our break?
No, I think we're ready for the break.
All right. Well, thank you, Eamon, Britta, Janice, for joining us. We'll see everyone back in 53 minutes. If my math is right.
It's a very accurate calculation.
Thanks, everyone. Have a good break and see you soon.